Welcome back to DIY Finance Guy. My name is Sergei Modilevski. Let's get started today by talking about how far real estate prices have fallen and where they might go from here. Let's jump right into it. The Canadian Real Estate Association confirmed that Canada's housing market slowed again in July, with the volume of home sales down significantly and the typical home price down 6% from the peak in February, marking the most significant decline since the 2008-2009 global financial crisis. It's worth noting that these declines did not fully reflect the impact of the Bank of Canada's most recent interest rate hike in mid-July, when the central bank increased its benchmark rate by 1 percentage point to 2.5%. Additionally, new home buyers must now consider that the Bank of Canada will be raising rates through the remainder of the year, with Chairperson Tiff Macklem coming out yesterday to say, "The best way to protect people from high inflation is to eliminate it. That's our job, and we're determined to do it. We know our job is not done yet. It won't be done until inflation gets back to the 2% target." Jump into the comments and let me know, how much further will the Bank of Canada have to raise interest rates to get back to its inflation target of 2%? Also, please hit the like and share this video to help me beat this pesky algorithm. Now let's jump back into it. Tiff Macklem made these comments after the Consumer Price Index rose 7.6% on a year-over-year basis in July, down from an 8.1% gain in June. The deceleration was the result of a slower year-over-year growth in gasoline prices. While it's encouraging that the headline inflation moved in the right direction in July, still, underlying measures of core inflation gained a step in July and are now running above a 5% pace when the Bank of Canada's mandate is a 2% pace. This suggests that the Bank of Canada still has some work to do to bring down inflationary pressure in the economy. TD Canada Trust economists have said, "We expect the Bank of Canada to continue hiking its policy rate at an aggressive clip at its next announcement in 3 weeks. We currently expect a 50 basis point hike, but it appears market odds tipped a bit more towards a larger 75 basis point move, likely focusing on the lack of progress in its core inflation measures." That informs us about what's going to happen with variable and adjustable rates in the months ahead. Now, let's take a look at the Canada 5-year bond yield to better understand what's going to be happening with fixed rates. Canada's 5-year bond yield has seen volatile trading since mid-June. After dovish comments from the US Fed, the yield went into free fall before a sobering job report abruptly stopped the fall. Since then, the July CPI report showed a lack of progress in core inflation, so expectations for central banks reversing course have disappeared entirely. Yields have continued to climb back up, and they're now down only about 16.6% from their peak. At the time of filming, HSBC was the first major bank to reduce their uninsured 5-year fixed mortgage rate from 5.19% to 4.79%. That might seem really significant. In actuality, it's about a 4% decline in payment, which is pretty negligible. Cumulatively, this suggests that mortgage rates and mortgage qualifying rates are going to remain elevated. And what we've learned, and we're quite certain of now, is that mortgage rates drive home prices. With qualifying rates at these levels, the National Bank of Canada believes that a downswing in home sales below their 10-year average should translate into lower home prices in the months ahead, with current forecasts calling for a 10% decline. Another area of concern for demand in housing are the mortgages that are being held by alternative lenders, private mortgagors, and mortgage investment entities. At the bottom, with the largest pool of outstanding mortgages, are the charter banks, monoline lenders, and credit unions that provide funds to prime borrowers at the lowest rates and typically no fees. These lenders can lend up to 80% of a property's value and have very few geographic limitations on where they can lend. Next, we have alternative lenders. These institutions cater a large proportion of their loans to self-employed borrowers or borrowers with past credit issues. Finally, we have mortgage investment entities or private lenders. Investment corporations often pool funds from endowments, corporations, and individuals to provide pooled mortgage loans. In these mortgages, applicants often have bruised credit, unverifiable income, and other mitigating circumstances that prevent them from finding better financing. Moving forward, mortgages with alternative lenders and private lenders are going to be coming up for maturity. Many of these alternative lending borrowers took out mortgage rates of 3.49% in 2021 and are going to see mortgage rates maturing at about 6.5% to 7.5%. They'll see an increase in payment of about 40 to 55%. The other risk is around the loan to value of these properties. Many alternative lenders are increasingly limited to lending 75% of the property's value as a mortgage, especially outside of major urban areas like Toronto, Vancouver, and Calgary. Considering the decline of home values, borrowers with alternative lenders may have limited options to renew their mortgage and even fewer options to refinance their mortgage if they have any outstanding debt. Private lending borrowers will find themselves in even more precarious circumstances. Many of these borrowers took out mortgages at 65% of the property value or higher. Most of these loans are interest-only payments, so the borrowers haven't actually paid down principal during the mortgage term. At maturity, these borrowers will need to pay renewal fees to the lender, and many will have seen home prices decline significantly. Some of these borrowers will need new loans at greater than 80% of the current property value to cover their outstanding loan amount plus fees. In this market environment, there's very few private lending options available at those loan to values, so many of these borrowers will have no choice but to sell. The Canadian Mortgage and Housing Corporation advised that alternative lenders and mortgage investment entities or private lenders made up around 18 to 20% of outstanding mortgages in Canada during the third quarter of 2021. A much smaller percent of these mortgages will actually face the challenges I've discussed. Still, this circumstance is likely to create more inventory in the months ahead. Despite what I've said today, many of you will still be interested in upsizing, downsizing, or may just want to stop renting. Now's actually an opportunity to enter into a buyer's market, where you'll have a rare opportunity to create a buyer's wish list, so you're able to choose the home you truly want for your family. Now, you might find that this is a lot more important than simply going out to speculate over where home prices may go over the next few months. Now's the time to lock in your mortgage rate and guarantee a payment while you go out shopping over the next 120 days. If you're going to get pre-approved for a mortgage or discuss a refinance, you can book a time with me and my team by using the calendar link in the description below. Other circumstances can change the forecast for housing on a dime. If you want to learn more about some of these catalysts, check out this other video here on your left and hit the subscribe button to your right. Please share this video with anyone that you think may find it helpful. Thanks for tuning in, keep well, and I'll see you in the next one.